In this video, I want to talk about a stock that has been generating 20% per year for 37 years. We will talk about a specific stock, all the story, we will talk about an article, the investor behind the investment, and the lessons we can draw so you can find these golden opportunities that generate 20% per year. This is the golden scenario we all want. So we have to learn from history, learn from the past, so we can find the next ones. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, looking for these golden opportunities. So I have a lot of fun reading about these case studies, and today we will talk about Balchem. Sorry, I never know how to pronounce this one. This is a small stock. Don't look at it. This one, the company has changed a lot. It's still publicly listed. You can type the ticker symbol on the internet. This stock, Balchem, has generated 20% CAGR, compound annual growth rate, for 37 years. This is massive. And the investor behind this investment is Larry Goldstein. Most of you don't know this investor. He's not part of this list of super investors. He's not on Dataroma. He has a fund that is called Santa Monica Partners, not on Dataroma. You can find his portfolio on Whale Wisdom. That's another website, and I will show you the portfolio later. Don't worry. I don't know how long this video will be, by the way. Just take a glass of water, a cup of tea, a cup of coffee. Enjoy. This will be story time, and I've seen 0 videos talking about this article, so we will have some fun. Who is Larry Goldstein? That's the longest standing shareholder of TPL, Texas Pacific Land, holding since the 50s. Sorry. He's the founder of Santa Monica Partners, a long-term value investment firm, and he's known for buying and holding exceptional businesses for decades. Most of the time, I've read his letters. That's public. The letters from Santa Monica Partners are completely public. You can find one video interview. The rest are articles. Very good investor that looks into micro caps, small caps, mid caps with hidden potential. And this is exactly what he found with Balchem. He turned small, under the radar bets into generational wealth. And I want to take a moment for this point of being a long-standing shareholder of TPL, because in an earnings call from Landbridge, on this YouTube channel, we cover specific stocks, including Landbridge. I'm a shareholder of Landbridge, full disclosure. And in the first quarterly call, in the earnings call in August 2024, so last year, who was on the call? Larry Goldstein from Santa Monica Partners. He asked a question about Landbridge that is very similar to TPL. They own lands in Texas. This is a royalty play, high margin, etc. So he starts saying, we haven't met yet, but I believe I'm the second oldest shareholder of TPL, having purchased it when I was about 13 years old, which was 75 years ago. So this guy that manages Santa Monica Partners, the fund, has been investing in TPL for a while and still holding. And if you look at his portfolio right now, you have, look at this is this one. You go to Whale Wisdom, you type Santa Monica Partners LP, and you find his portfolio. The biggest holding he has is TPL with 40% of his portfolio. That's massive. I believe it was a small position in the past, but TPL grew so much that now it's a massive position. If you look at the stock price for TPL, it's just phenomenal. It's plus, I can put the website in English, plus 50,000% gain since the beginning. This is massive. And we have data back to the 80s. So you can guess the performance since he first bought. This is just phenomenal. So we have the proof here. That's a long-term shareholder investing in small companies when they are hidden and holding for a long time. And this is not the first time he does it. He did it with Balchem. He bought a long time ago and has held it through today. So this is very massive. And the source of this video you're watching today is this article, Joe's Note. I stumbled upon this article on Twitter. Please go to his website. This is a recent writer, and that's beautiful. That's a wonderful article. Please go subscribe, read the article. You can, I don't know if you can send support to this guy on Twitter or anything else, but that's just a very, very well-written article. So let's start. The title for the article is 20% CAGR for 37 years. So I think what I will do is I will read and comment on this article. So maybe it will be a little bit long, but you will have all the information because you have nuggets of wisdom inside this article. The research is great. You have a paper from Jason Zweig on the Wall Street Journal. This is very well written, and it shows you how brilliant your ideas can be sometimes. And if you find one, it will generate 20% per year. So it can be done. So, okay, let's start. An obscure 800 bagger. You multiply your investment by 800. I don't know if that's enough zoomed in for you guys. Let me put my face up there. And yeah, I hope I put the text bigger. Larry Goldstein started buying Balchem stock in 1988 for less than 20 cents. Today, it trades at $170. If I go through Balchem now, the stock is at $170. Yep, here we go. This is the stock price. This is what it looks like. The company IPO'd in 86. He bought 2 years after this in 88. And since then, it's a wonderful run. It's been a wonderful run. Let me continue. Larry's 37-year CAGR in Balchem is north of 20%. He has held onto the majority of his shares over this period, only occasionally distributing low basis stock to redeeming limited partners. A 6-figure investment has turned into 9 figures. This is just phenomenal. Given he bought and held his shares, there have been no capital gains taxes or other frictional costs. Despite the huge return, the Balchem case remains largely unknown outside of small circles of investors. You watching this video, do you know Balchem? Do you know the company? I don't think many of you knows this company. I don't know. I don't think many of you are aware of what they do. This is the story of how a patient, well-researched bet turned into one of the best performing stocks over the last 40 years. Okay, so now we will talk about what this company does in 1988. Larry started buying Balchem in 1988 after reading the 1987 annual report. By the way, if you don't know who Larry Goldstein is, you will find some interviews on paper, not video interviews, but articles when he was younger and he hired a bunch of young analysts and went through all the pink sheets. So the small hidden companies, small caps, micro caps, and he spent hours and hours and hours looking for a great investment. And fun fact, you have one article, he mentions that his wife, Larry Goldstein's wife, made him a choice, like either you choose me or you choose your stocks, because of the time commitment he had for investments. And apparently he went on a divorce. So this is somebody with a lot of patience for stocks. This is somebody that likes to dig, to turn rocks, and that's a clear sign of optimism for us. The more rocks you turn, the more chances you will have to find the next Balchem. So continue digging, and this is what I do all day long. So I keep digging and turning rocks, and once in a while you find some golden opportunities. This is the annual report from 1987. Very well, Balchem capsule process. At the time, Balchem was a 2-segment chemical company engaged in 1, producing sterilant for the healthcare industry, and 2, microencapsulation, primarily for food ingredients. Annual sales were $7 million and operating profit was a little over $700,000. So you have a margin of 10% roughly. The company had $1 million in debt and $100 million of cash. Valuation figures were as follow. You have a PE ratio of 10. Okay, so operating margins, EBIT margins of roughly 10%. For a company with a little bit of debt, you have what? $1.4 million of debt compared to EBIT of 700K. So you can pay off your debt in 2 years of operating profits. Not a debt issue to my knowledge. And this could be available at a PE ratio of 10. So the full financials for those interest rates, you can put pause in the video if you want to have more information. But basically, like a lot of chemical companies, this is a cyclical industry. So sales are not very predictable. If you look at the sales for the past 5 years, it was $7 million and then 5 and then 6 and then 7 again. And the cost of goods sold have been reduced. So margins have improved over time. And this is your net income, net earnings, $300,000, negative 100K, 400, 300, 400. So nothing really sexy for the moment, nothing really enticing, but the rest will be much more appealing to you. By the way, if you want help with your portfolio and improve your returns, click the link in the description to book a free strategy call with me. We will see how we can work together to grow your portfolio in the long term. Now, if you look at the balance sheet, you can have a sense of what the company does. This is a new IPO, as we've seen by the stock here, starting in 1986. So they raised some cash with the IPO. This is why you have a lot of cash here. And you have some lands, you have some buildings, equipment of $3 million, nothing that is a big deal, nothing spectacular, nothing to see here. What about the debt? Long-term debt, $500 million, current portion of long-term debt. So this is part of like short-term debt. You have a little bit revolving credit here. So you have revolving credit of $700,000, okay, plus current portion of long-term debt, so short-term debt, that's plus 200, so $900,000, sorry, and you have long-term debt 500, so 700 plus 200 plus 500, you have $1.4 million worth of debt. Okay, very well. Let me continue. 7 times EBIT and 10 times earnings for the valuation. Seems decent, but not screaming cheap for a tiny, thinly traded public company. Yes, obviously. At the time, it was a $4 million company with the market cap. So this is very, very small. And that is the equivalent of a $10 million in market cap in 2025. So it's as if you found a chemical company right now with a market cap of $10 million. Actually, I find these opportunities. I have some of them on my watch list. So you can get some tiny companies like this. But most of the time, these are value traps. So you have to really hedge your bets. You can find some opportunities right now. It's harder, but you can find them. But the growth was strong and incremental economics attractive. Consolidated sales in 1987 grew 18% from last year and were expected to continue to grow around that level. If you look at the revenue, boom, this is the difference. 86, 87, you grow a little bit. Yes, if you only look at the year-on-year performance, the growth can be appealing, but if you look at the past 5 years, it's not that great, right? Both segments were growing, but the sterile business looked especially promising. Now it gets interesting. And this is also what we preach on this YouTube channel. When we do an analysis of a stock, we look at the numbers, we look at the quantitative data, but it's also good to look at the qualitative data because that is maybe more important for long-term investing. So, sterilization from the 1987 annual report. He highlighted this one. Indeed, this material is so effective, what they sell, that the Center of the Disease Control in Atlanta has recognized it as a sterilant for the AIDS virus. Balchem is one of only 2 companies offering this specialty chemical to the healthcare industry. Very interesting. Very interesting. You don't find this in a lot of annual reports. They are clearly saying that this is a duopoly, 2 companies, okay? And later in this article, they will talk about the other company. You will see that it's a very different story. Balchem started manufacturing and selling ethylene oxide in the mid-70s. Prior to ETO, so ethylene oxide, most medical device sterilization was done with steam. These presented problems when the objects being sterilized could melt or warp from heat. It was especially bad for small, delicate parts made of synthetic or plastics, like heart valves and pacemakers. Sorry for my accent, I'm French, quite tricky to read this stuff, technical terms for health. Sorry, don't put comments below about my accent, I know it. ETO solved the problem by being a temperature-neutral gas cleaning agent capable of invading every nook and cranny of even the smallest, most delicate devices. And they also talk about something else. As a clearly superior solution for specific applications, ETO has tremendous growth potential. Sales of our specialty chemical sterilant for healthcare products continued to set new records. So, they have 2 segments. Out of 1 segment, there is a pocket of opportunity that is growing extremely well. So that's it. You have Balchem, 2 segments. In 1 segment, you have a lot of stuff. And one thing in this segment is growing immensely and has a lot of potential. Ironically, the principal obstacle to increased sales and earnings in connection with this specialty chemical now is oppressive regulations. That would be unfortunate for everyone concerned, as deaths due to infection have occurred elsewhere when this uniquely effective sterilant has been replaced temporarily. So if you don't use this thing, you have more damage to society. So this thing that they are selling, and they are only two companies selling this, is very important. And if there are only 2 companies doing it, maybe you have some barriers to entry, right? This is some good qualitative question to ask. ETO was controversial due to the potential dangers of its transport, due mainly to flammability as well as environmental concerns. Larger companies were hesitant to enter the market and take on additional potential liability. This is sign of a moat. If you are a tiny company that is operating and you do a niche product, and the big guys don't want to come to the arena with you, that's potentially a sign of a moat. Good takeaway for you guys. Look at annual reports because you can have some nuggets of opportunities like this. Those who did tried blending ETO with other gases to reduce flammability, which was expensive. Oh, okay. Those who tried blending ETO with other gases to reduce flammability, which was expensive. I'm not sure of this sentence. Okay. Balchem's approach was to seal the gas in reusable drums that could be delivered by truck, making it cheaper and safer than alternatives. So they have their solution, their alternative that is working well and growing massively. The only real competitor was Union Carbide, a much larger and more bureaucratic company with many different product lines and segments. UCC, so Union Carbide. UCC was going through a restructuring in the late 80s, driven in part by lawsuits and environmental liabilities related to multiple chemical leaks and the Bhopal disaster. Again, sorry for my accent, guys. I'm trying my best. So the only big competitor Balchem had at the time was a big conglomerate that was going through a restructuring. I mean, that normally when you are big, you are slow. So if you are, I mean, this is what Warren Buffett and Charlie Munger has been saying. Most big companies are complacent and bureaucratic. And in this arena, when you have only 2 players, either you can bet on the large player or the niche player. Most of the time, it's better to invest in the company most focused on this product. And out of these 2 companies, Balchem is niche, is flexible, is agile, they can pivot swiftly, they can be much more efficient. So you have, this is like David and Goliath. EBITDA was around $1 billion versus more than $3 billion of debt and long-term obligations, plus undefined legal liabilities and costs. So they have lawsuits, they have bureaucracy, they have a lot of problems, they are big, this is a big company. This is, I see this happening a lot of the time. And by the way, quick tip for you, there was a question that was asked to Charlie Munger a couple of years ago about the size for companies. Exactly this problem. When you are small, you are niche, you are flexible, you are agile, you are fast, and then you become big, and then you hire a lot of employees, and then you have lawsuits, and then you are diversified, you are a conglomerate, and you are slower. And somebody asked a question about this to Charlie Munger, and Charlie Munger said it was exactly like nature. There is a reason why the biggest mammal was the elephant or the giraffe. You don't have animals that are 50 meters high. You have a limit to size because of the blood pressure that goes to your legs, to your arms, etc. The same thing goes with businesses. You can't be of infinite size. This is part of capitalism. You have small guys that will disrupt you, that will when you become too big, you become a threat, you become, you become a prey to other flexible companies or animals. So similarly to nature, capitalism is harsh, is fierce. And the same thing is happening with Balchem. So in this article, you have the financials for UCC, so the big companies. I don't want to dwell too much into this, but you have sales that are growing a little bit. You have a lot of debt. This is a complacent big company. It happens time and time again. So ethylene oxide was buried within their industrial gases segment, most of which was focused on industrial manufacturing, not sterilization. So same thing. UCC, the big company, is not only focused on this niche product that we will talk about later. They are a diversified conglomerate, and the ethylene oxide, this niche stuff, was inside a bigger segment called industrial gases, and this was not their priority. Industrial manufacturing was a larger market for Eto than sterilization at the time, and that's where UCC was focused. Compare this with the other company, much more flexible and can be focused on this one. So this was a small market in a subsection of a segment that wasn't their largest. If you look at UCC, so the big company, they have 4 segments, including this one, industrial gases, and inside industrial gases, you have this chemical. Big, bloated, bureaucratic, indebted, scattered. All of this to say, UCC was a great company for the nimble Balchem to compete with. Yeah, very well said. Over the years, Balchem's higher volumes contributed to a cost advantage which, when added to the potential liability, has kept competitors at bay for more than 3 decades. This is extremely well put. If you want to do the research on your own, you can read these annual reports, but you have a big company and a small company, and the small company has built a moat over the years. And if you have this inertia, you can have a cost advantage, some partnerships with suppliers, an advantage for transports. So over the years, because of no competition really, or not a fierce competitor, Balchem has built a moat. And small companies that are building a moat early on create tremendous opportunities for us investors. So this is a case study of how to dig deeper into small companies before they are known by the public. This is a very good article. Now you have a paragraph about microencapsulation. This segment was also growing with lots of potential. So something is in yellow highlighted. Microencapsulation may be viewed as the development of a specialized package for the reactant. The package is designed to protect its content from perimeter reaction, but then to release them under the desired conditions. This technology obviously has almost unlimited potential uses. This microencapsulation business had long lead times as food companies required extensive testing, studying, and different rounds of approval. But these were large companies with potential for high volumes. And you will see that once you find, I have another story to share with you. As I told you, take your time. This video, I don't know how long this video will be, but you will have some value. For Balchem, you have a technology, and as time passes, you have more revenue streams coming out of this technology. First, they talk about the niche, they talk about health reasons, and then they will talk about animals, animal food. You will see this later. And the same thing goes with TPL. So we talked about Santa Monica Partners, we talked about Lawrence Goldstein, that is the second oldest shareholder for TPL. TPL is very similar. TPL has lands in Texas. At the beginning, it was for farmers, and then trains, transports. It was a private company, then public company, private, public, founded in 1888, very old. And as time passes, they found new uses for the lands. So we found oil that you can drill on these lands. And then it turns out that you can have, I don't know, solar panels, or you can build a data center on these lands. And then you can have some water infrastructure on the lands. So as you have more technology going forward, more development of the human race, you have new revenue streams based on one company. The same thing goes with Balchem. Okay, in 1987, Balchem was expensing these efforts without realizing the future benefits. This pointed even more towards the possibility of future growth and margin expansion. Working with potential customers to develop the optimum product for their new uses is a considerable investment for us. Okay, maybe a lot of companies are saying this, so maybe it was tricky to see the value at the time. When they do succeed, our sales jump considerably as the companies we deal with are quite large and displacement of our product by a competitor is most unlikely. Similarly, they say that they have a moat and no real competition. This is a technology with an expensive present but a bright future. Okay. The big opportunity at the time was the McLean Deluxe hamburger from McDonald's, which used Balchem's microencapsulated salt. If you are old enough to remember this burger, please comment below. It was a burger that was there at the time, that is no longer here. Once food formulas and ingredients are locked in, companies don't like to change them, due mainly to the risk of ruining the taste and consistency. This was especially true in the case of McDonald's, a company known for sticking with its suppliers. That is very true. Unfortunately, the McLean saga ended in 1996 when McDonald's discontinued it. It was not that profitable for them. The McDonald's Corporation will discontinue its reduced fat hamburger, McLean Deluxe, after it did little to improve the company's bottom line. No profits. No big profits over there. Okay. But there were other food products that worked out very well, like Sour Patch Kids, where Balchem makes the face puckering crystals on the candy. When you eat a candy, it's a little bit acid, and that's part of Balchem's product. All told, on a consolidated basis, Balchem was growing sales in the high teens, with potential for added lumpy growth from encapsulated food products, with room for margin expansion. So, they started small, with the small chemical stuff, and they had some deals with big brands, a candy company or McDonald's or something else related to health. And it turns out that you had some demand, and they clearly said in their annual report that they were dealing with big customers that bought in big quantity. And if you buy in big quantity, you have a scale advantage. Think of Costco or this kind of this. Like the more quantity, the more discounts you can get from your suppliers, and the better it is for you. So you can increase your margin, increase your efficiency, and increase the sales accordingly. With a return on capital of around 20%, like a ROIC, return on equity, return on invested capital of 20%, a high teens growth rate could be achieved primarily with reinvestment of internal cash flows, with the help of some occasional borrowing. As we've seen previously, the debt was not a problem for them. Equity raises were limited only to options and warrants granted to employees and directors. Now we'll talk about the people. They talk about the management team and the changes we've seen over the years, because it was a long time ago, so the management team has changed. Herb Weiss founded Balchem and served as president until 1997. Herb took the company from a technology idea, microencapsulated ingredients, to a legitimate commercial enterprise with blue chip customers, including General Foods, Unilever, Nestle, and RDR Nabisco. I don't know this company, by the way. You have big customers, and most of the time, because of taste, ingredients, they don't change the formula for their products. So these are great customers to have. Dino Rossi took over in 1997 when Herb retired. Dino did a lot of good things and took the company from $30 million in annual sales, in revenue, to over $500 million in 18 years. That's a CAGR for revenue of 17% per year. There are not a lot of companies that can have a CAGR of revenue. CAGR means compound annual growth rate. Like on average, you grow 17% per year for 18 years. You don't have a lot of these. So that shows a lot of efficiency from the management team. He did this through organic growth, new products, and bolt-on acquisitions. A big growth effort was the introduction of micro-encapsulated products for animals. For example, vitamin C is fed to fish for their proper development. It used to be sprinkled into the tank in powder form, which resulted in roughly 80% of it being wasted, 20% consumed by the fish. Micro-encapsulated vitamin C flipped this ratio on its head. You have a market that was efficient, and these guys came with a solution that was much more efficient for the whole industry, basically. You had a lot of wasted resources, and these guys came with a solution. Like always with capitalism, and normally if you are positioned in the right moment, you make a lot of money. Similarly, under Dino's leadership, Balchem found an encapsulated solution for cows and their compartmentalized stomachs. The company developed a coating that could survive the rumen and dissolve later on in digestion, better delivering the nutrients. Yeah, this is tricky. I'm not I'm not a cow guy, so I'm not very well aware of exactly how to be very efficient for animals' food, but you get the idea. You had an industry with inefficiencies, and these guys came to optimize, to have an efficient system for everybody, for specific animals. So that means some cost advantages for farmers, companies, etc. Dino also completed various bolt-on acquisitions in the early mid-2000s, compounding EPS, earnings per share, at 18% per year from 1998 through 2015. Similarly, you don't have a lot of companies that can grow 18% per year their earnings per share for 17 years. He knew every company and subdivision of large companies that he was interested in acquiring. He made Balchem known as a strategic buyer and never paid finder or banker fees. Yeah, you don't have, in 2025, it will be a little bit trickier to find these kind of opportunities because the world is much more bankerized. I don't know how to say it in English. You have a lot of investment banking that are pushing for more acquisitions. But apparently at the time you could have some big acquisitions without paying any fees to your broker, to your investment banker. And this is exactly what they've done, so you save some costs. As a result of the strong growth, cost control, creativity, and attractively priced acquisitions, Balchem stock increased from $2 to $60 during Dino's 18-year tenure as CEO. That means a 21% CAGR before dividends. So that's 21% CAGR minimum. The outcome, as Larry wrote in a letter, now we are talking back about Larry Goldstein from Santa Monica Partners, that wrote in 1990, we bought into this established little company whose stock is basically unknown at a low multiple of current earnings. With luck, there could be dramatic expansion of both earnings and price earnings multiple, PE ratio. So we've seen at the beginning of this article that you had a PE ratio of 10 for a company with some good potential if it works out. So you can make a tiny bet of your portfolio and not bet the farm on this one. You can make a tiny bet of your portfolio and it will work wonders. Were there ever? Yeah. The result is one of the best performing stocks of the last few decades, returning roughly 20% annually from price appreciation through the present date, with a couple more points added on for dividends. So you have a very good writer, Jason Zweig, that wrote about Balchem, this company, in 2016 in the Wall Street Journal, in an article, the best stock over the last 30 years. You've never heard of it. And he says the best performing US stock over the past 30 years isn't a household name. It's Balchem Corp, a lot since 85. And stocks don't come much more obscure than this. Yeah, okay, Balchem makes flavorings, fumigating gases, and nutritional additives for animal feed. Since the end of 1985, Balchem has gained an average of 26% annually. So now we know, maybe with dividends included, between 1985 and 2016, you could have 26% per year if you found this opportunity at the time, or if you just knew Santa Monica Partners and followed them. The same thing you may do right now with Dataroma and you follow Warren Buffett, Bill Ackman, Terry Smith. If you did it with Lawrence Goldstein, you could have found this opportunity. Performance was even better the first couple decades when Balchem's ROE, return on equity, was in the high teens, low 20s. Oh, that's very important, by the way. Please stay on this video. Leave a like if you want. This is quite important. So the performance was better when the efficiency was better, when the return on capital was higher. So return on equity in the low 20s, like 20%, 25%, okay? The return was obviously helped by a period ending PE ratio of nearly quadruple when it started. Yeah, now if you look at Balchem stock, the PE ratio is 40. Oh, sorry, that's a website in French. Let me put in English. Cost benefit. No, that's the PE ratio, that's 40 right now. So he bought 40 years ago at a PE ratio of 10, and now that's a PE ratio of 40. Obviously, if you multiply your valuation by 4, you will have a stock price that went up by 4. So maybe you want to adjust it a little bit, but still, if the PE ratio was 10 right now, it would have been a beautiful investment. Owning a stock for 35 years or more is a tall task. But even shorter-term investors who bought the stock in 1989, so they were a little bit late, would have compounded their capital at 50% for the first 3 years of ownership and 30% for the first 5 years. I mean, you can be a little bit late, 1 year late, 2 years late, and compound your wealth. It's never too late if you are in this extremely high compounding efficient business models. This is a great lesson for you guys. Sometimes you think it's too late, it's not too late. And what I said about not betting the farm on these micro caps, look at this. Larry Goldstein invested roughly 2% of Santa Monica's assets into Balchem at cost. So only a 2% bet. It was a speculative investment because it could have failed. The company could have been bought out, acquired by the other company. It was a duopoly, so they were two. A lot of bad things could happen. Maybe they are not efficient. Maybe the CEO leaves. Maybe the company is becoming goes private, acquired by a private equity firm. Anything can happen. This is quite speculative, and this is a good lesson for you. When you have these speculative assets that can have a multi-bagger potential, maybe a risk arbitrage, a portfolio allocation is very important. So he invested only 2% of his portfolio. Had the other 98% gone to zero of his portfolio, Santa Monica Partners still would have compounded at 7% before fees. So even if, only 2% of his portfolio into Balchem would have generated 7% before fees if everything else goes to zero. This illustrates the power of even a singular winner when compounded over a long time frame. This is the historical financials. Please, you can make a pause in the video if you want to take a screenshot. That's it, but you will have all the financials over there. Let me continue. Larry's comments. So the guy that wrote this article, wonderful article by the way, wrote a message to Larry Goldstein. I showed Lawrence Goldstein, a draft of this post before publishing and asked if he would like to add anything. Below are his comments. Dino Rossi was the treasurer of Auket Company in Texas. One of the board members of Balchem was on Auket board and recommended Dino to Balchem to be their CFO. The company didn't have a formal CFO at the time. Only one name was in the annual report. Herb Weiss. There were no officers or directors mentioned. When Herb retired, the board made Dino CEO and eventually chairman. This is a microcap. You will have a small management team. Dino began to make moves that really moved the company forward. He was businesslike. Herb, so the founder at the time, the prior CEO, Herb was a scientist and he was good at it. But Dino was a businessman and thought in terms of profits. He understood the value and went to work building it up. Yes, I have a book, The Outsiders, from William Thorndike that is great. And this book shows you 8 different CEOs focused on business, capital allocation. And if you invest in driven CEOs like this that are business-like, you can make a fortune in stocks. And I believe Dino is one of these CEOs that can compound your wealth over a very long period of time because they are so good at what they do. That was hard. Building up. When Dino took over, they were working on surviving by passing the rumen in cows and other animals. They were the first to figure out how to do this, how to encapsulate the nutrients to survive the rumen. That was hard, but even harder was getting veterinarians to approve it, being a conservative group that took years to get approved. 8 or 9 years, I believe. I remember Balchem working with Cornell, one of the best veterinary schools in the nation, to prove their micro-encapsulated products were safe and effective. In the science, health industry, it's very hard to move fast. You want things to be safe, so you need to be approved first. It will take some years to move on. Once approved, it was a floodgate. Providing nutrients to animals was a very profitable line of business. They provided all kinds of supplements to dairy cows and other animals. Then there was a human nutrition and other applications. It all snowballed. So once you are in this golden position, you stay invested. You stay invested because the revenue will grow immensely. The organic growth was strong for many years and acquisitions helped too. The way Dino did acquisitions, he knew what he wanted to acquire in the way of products or or capabilities. In all cases, they were small private companies or subsidiaries of larger companies. He never paid bankers or brokers. Everything he bought, he found himself. The stock has slowed since Dino's departure. The valuation isn't cheap, and management is no longer laser focused on return on equity. It's still a great company, but the string of unlevered high teens return on equity appears to be over. So now you may think, what a beautiful company. This is a great story. Can I invest in Balchem now? Do you have potential? One, the stock has a P ratio of 40, so maybe not as appealing as in the past. Secondly, I also checked the financials. The return on equity, the return on invested capital has gone down over the years. So the business is not as efficient as in the past. Third thing, the management is not as focused as in the past. And this is no longer a small company. You have a market cap of $5 billion. But because I have some notes with you, I want to give you some value. Okay, so now I have some notes, some bullet points. I hope you liked the story. Again, sorry for my accent. That's some technical terms for me. First, the power of long-term compounding. That's a 800 return. An initial investment of 20 cents per share has grown into more than $100 per share. So that's one of the benefits of what we preach on this YouTube channel, investing for the very long term. And if you are in the golden position, you just sit and wait. You sit on your hands when you are in a very fortunate position of owning Balchem. And also the way he had a lot of earnings and you had the 800 returns is with minimal transaction costs. You don't have a lot of trimming, you don't have a lot of buying, selling, trading. That's the advantage of long-term compounding. What we do, we invest for the long term. You will have minimal trading activity. By holding the investment with minimal trading, Goldstein avoiding capital gains taxes and transaction cost, maximizing net returns. So now, how to identify underappreciated opportunities? First, the opportunity must be small. It was a micro cap, equivalent today in 2025 of a market cap of $10 million, so very, very small. Balchem was small, thinly traded company with a market cap of $3 million for all the dollars, right? And very overloaded. You don't have a lot of institutional funds invested in Balchem. It was a niche market focus. The company's specialization in sterilants and microencapsulation positioned it uniquely in markets with limited competition. You only had two players, one big bureaucratic, large, complacent company, and Balchem with a niche that was not sexy at all. 3. Competitive moat through innovation. First, the sterilization technology. So they use a specific stuff because they are expert in what they do for sterilization, and that gave them an advantage for R&D. Secondly, the efficient delivery. We talked about having large customers, so you have an advantage for transport, cost, efficiency, extremely well run. I mean, this is niche. They know what they're doing. This is safer than competition, and this is what differentiated Balchem from competitors. Fourth, strategic patience and discipline. Now that Larry Goldstein has invested in Balchem, and the stock has gone up 50% per year, 30% per year for a couple of years, I'm sure he wondered, do I trim the position? Do I sell the position because the stock has run so much? In this scenario that you will have to, when you have an extremely good run for a stock, you don't know what to do, you have to know your stock, know your company very well, and ask yourself the question, does it have legs for future growth? We've seen with Balchem that they started with health, they went into food, they went into McDonald's burgers, they went into candies, they went into animals. You had additional layers of revenue stream, additional tailwinds. Ask yourself this question for any company if you face the same situation. And in this situation, you have to avoid the noise. I'm sure you had a lot of crazy, macro, scary headlines at the time. In the 90s, you had a recession, 1997 too, 2000 dot-com bubble, 2008. He just held through everything because it is a niche market. They are almost monopoly, duopoly, high market share, very efficient, and the fundamentals are improving. So as long as the fundamentals of the business are improving, the best thing is to hold, despite all the scary headlines you may find on the internet. So, avoiding the noise, Goldstein commitment to a long-term holding strategy required resistant market fluctuations and short-term news. Again, focus on fundamentals. And now some lessons for you guys, and that will be the end of this video. First, due diligence. Not a lot of people have analyzed Balchem at the time. It was a microcap, but now what is great is we are in the you have a digital world. You can have screeners. You can use FinChat or Stock Unlock. Both links are in the description below if you want a discount code, if you want a promotion that's cheaper. Maybe it's free for the first 2 weeks. You don't even have to put your credit card. Click the link in the description for the promo code, and you can try the screeners. You go on the screener, you put return on equity 20%, you put market cap very small, and here you go. In the US, of course. In the United States, you will find golden opportunities with an earnings per share that can compound at 15% per year, at a PE ratio of 10. You can find them. So it's very easy and convenient for today's world, actually. Due diligence, thorough research into companies' financials, market potential. Once you have done the screening stuff, you have found some potential names with good quantitative numbers, quantitative data. The other exercise is to go through the qualitative aspect of the investment. So this is maybe the hardest part, to really understand the business model. Long-term vision. Investing with a multi-decade horizon can unlock substantial wealth, especially when combined with a strong business model. Tax efficiency. If you don't sell, well, you don't have taxes. Update. This is for you guys. Larry Goldstein recently sold 40% of his portfolio. Check his portfolio here. I have his portfolio, and now I'm recording this video in May 2025, and look at this. You have Balchem, that was his second or third largest position. He sold 40% of the position. That's quite big, actually. That's quite big. So right now, as we are speaking, he sold almost half of his position in Balchem for any reason. Maybe he want to collect cash to buy something else. We will see later. I will continue to follow his portfolio and update you if there is something significant. But if you wanted to invest in Balchem now, maybe it's already too late. But it's okay. The goal was not to invest in Balchem right now, right? It was to invest in the next Balchem. How he spotted Balchem at the time. Let me continue. Now, how to spot the next Balchem? Yeah, this is a great segue. Look for small, profitable companies with high ROIC. As I told you, click the link in the description, FinChat, Stock Unlock, you go on a screener. These are the best screening tools I have found on the internet. And you research for microcap, profitable, high return on invested capital, high return on equity. Focus on businesses under $1 billion of market cap, consistent free cash flow growth, strong return on invested capital, and low debt. 2. Check for steady organic revenue growth over the last 5 or 10 years. Prioritize companies growing without acquisitions or excessive dilution, showing clear product market fit. 3. Analyze the business model for hidden moats. This can be a little bit tricky. It can take a while for you maybe to analyze. If you are an advanced investor, it will take a few minutes. If you are a beginner, it will take much more time, but that's okay. That's fine. This is also what I help my clients do. And you look for the qualitative data, how to spot a moat. Seek niche players with high switching costs, pricing power, or regulatory barriers that protect them from competition. Study management, capital allocation decisions. The capital allocation management team stuff was very important for Balchem. It was a founder-led, very efficient, driven management team that focused on return on equity and growing organically. They didn't want to pay the brokers, the investment bankers. They were anti-Wall Street and they just focused on business efficiency. So this is about culture. And you can't find culture on a screener. This is what I say. look deeper. First, you have the screener, the numbers, and then you go and you do the qualitative analysis. Study management's capital allocation decisions. Read annual reports and look for rational reinvestment, share buybacks, or debt reduction, not just top-line growth. Make sure the company solves a recurring, unsexy problem. Oh, this is key. We've talked about the fish and the efficiency of the waste in powder, the food you have for fish. This is solving a recurring unsexy problem. Focus on essential products or services with long shelf lives, not trends. Think B2B, industrial, or healthcare inputs. If you like this video and want help improving your portfolio, click the link in the description below to book a free strategy call with me. We will review your situation and see how I can help you get better results over time.